We'll do it live.
Okay. No.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back, everyone. Hope you guys having a great day. Market closes today a little bit down in the red, but we're going to be going over the topics that I have set for us here today. So if you were invested in any high beta name, you probably got a little bit clapped towards the end. I think market started to decay roughly after lunchtime. If you look at some of the really high beta names this year, like Carvana, comes to mind, and think of all the other retail stocks that people are invested in. Not that Carvana is the most popular retail stock by any stretch. Carvana, let me just actually, before we get into the other topics, is I think up over 1,000%. Yep, 1,097.62%. So if all your investments that you guys focused on this year, all of them are worthless by comparison to Carvana, as I'm reminded by some of our club members, not daily, but McBuddha, shout out to you. You're like, why are you even happy about your investing performance when you could have just bought Carvana the whole time? That is true. So used to care and have different backgrounds other than the fake bricks. I can change them if you want. We can do I think I have the executive bathroom. Look, recall this one, the executive bathroom. All right, we'll do this one today just to make it a little bit different today. Yeah, but yes, the current brick walls are not real. Okay, I own both Google and Amazon, which gives me exposure to streaming, but that's not the main reason for ownership. I don't know about just owning Netflix on its own. Okay, so we're going to be talking about the streamers real quick. As you guys know, that my largest ownership in a streamer is in Netflix. And well, if you count Amazon's now larger than Netflix, but the pure play streamer, it's Netflix. I had a very small position in Warner Bros. Discovery at one point, but decided to exit the position simply because, one, I thought it was going to be dead money. My opinion back then, and turns out it actually was true. And we're going to be talking about some of the risks associated with Warner Brothers Discovery, and I'm going to be actually showing you a story behind this. Something that's a bit more problematic. Why do you think, or why do I think that they're doing this merger here? So they're doing a merger, or the merger was announced today, and it was reported there's going to be one between them and Paramount. So Paramount, for some reason, also has excitement just because Warren Buffett is invested or was invested in Paramount Pictures. And this is one of the companies that actually was responsible, or not responsible, but involved in the massive crack up boom over here with the hedge fund. Already forgot their name. Who cares? That hedge fund is no longer with us. And since then, if you were the unfortunate soul who, for whatever reason, bought somewhere around there, you're down 84%. Even from down over here, you're still down about 62%. We hit a low around $10.70, and it rallied 44.86% from that low. But there are some glaring issues with Paramount, along with Warner Brothers Discovery. I think Warner Brothers Discovery hit, roughly, I think the $9 or $8 a share on their low. And I can't really zoom out here, but you also have to trust me that they experienced very similar movement at the time via their Discovery shares, but we don't see that here on Google. So the Paramount move that we see here, when it was called CBS, the same thing happened to Discovery, which is merged with Warner Brothers to become Warner Brothers Discovery. So what are some of the issues associated with the streaming platform? So if we go over here, we have, let's skip this one for now. I want to go to the November 2022. So in November 2022, you see the breakdown here on the right-hand side. And this is pertinent because we were also, when we were investing in Netflix, that was early 2022. And I have a long video that you guys can watch on the channel that goes over the thesis on Netflix when Netflix was trading at 180 some odd dollars a share. And nothing's really changed since that video was published. So I won't really make a new video. I don't really have the intention to make a new video. And I feel like the thesis has played out. But going through that point, or some of the points that we addressed in that video, is looking at the popularity of each of the streaming services, and we're going to see how they've progressed across time. And I think it's actually really interesting to see the progression. So we see at the top we have YouTube, and then we have followed by Netflix, Hulu, Prime Video, Disney Plus. At the time in 2022, a lot of people were saying Disney Plus was going to take over, et cetera, and HBO Max was also going to take over. Let's fast forward to January 2023, so not too long after that, and we see that HBO Max is still somewhere in the same spot. We see a little bit of a rise. I'm going to put them back and forth. So we have Prime Video 2.6, Prime Video at 2.9, Hulu 3.5, Hulu 3.9. So we see that Prime Video starts to tick up a little bit, and Netflix and YouTube still in the same position. Now, if we fast forward to November 2023, which I have for you guys right over here, and I'll go ahead and zoom in because I know for oh, actually, I wasn't even sharing it with you guys. I'm so sorry. I'm so sorry, guys. All right, we'll look at them one more time. Apologies. So we're gonna look at the 2023. That was an epic fail. All right, so 2023 January, you can see the difference here, and then I'll show you November 2022. So I already went over the numbers, but just take my commentary and attribute it to the image here. At the top, you have YouTube, Netflix, Hulu, and Prime Video starts to creak up a little bit. So if we go to October 2023, more recently, we see now that YouTube is actually at the 9.1%, Netflix still in the 7 range. But here's the difference. You see who came in right after them, Prime Video. So Prime has actually been making headwinds right into streaming. And then if you combine Hulu and Disney Plus, Disney is right there, actually overtaking Prime Video. And then Tubi's there, but HBO Max is at 1.2%, and Paramount Plus is at 0.9%. This is a major problem. Okay. Now, with the economics of streaming, you do have some nuances that I think people overlook. One is that streamers don't really care all too much, economically speaking, if you're watching the content or not, just that you're subscribed, unless it's an ad-based platform. If it's an ad-based platform, they really do care that you are watching because they can support ads. Now, there is something to be said that if you're not watching content on the platform, you are more likely to cancel the subscription. So they would prefer that you are getting use out of the product and that you are then going to continue to subscribe. But technically speaking, for example, if you're a Netflix subscriber and you're paying for a Netflix subscription, it doesn't necessarily mean that Netflix needs you to be watching Netflix every single day. Although if you watch Netflix every single day, you're very unlikely to probably unsubscribe from Netflix. That also being said, you're also costing Netflix, and they're making that subscription off of you. And let's say you watch one show a month on Netflix and you're giving them that subscription, they're still happy in that instance. If you're in the ad-based tier, of course, they'd prefer you to watch more of the content so that they can support the platform with further ads. YouTube, which is a primarily ad-based platform, really wants the eyeballs there. So for their business model, it's really important that YouTube is still continuing to attract more and more eyeballs, more and more view time. Now, you go down to some of the other platforms that have grown more so through the ad-based platforms. Like I'm thinking of Peacock there, Roku channel as well, Paramount Plus. These are going to be a little bit more supported and have a greater propensity for the ad-based platform. It's more affordable and cheaper. And so for them, it's going to be a bit more important that they gather the attention, and they're losing out quite drastically here. So if we're looking at the scale or the rankings here, Max and Paramount Plus merger wouldn't even put them close to where Disney is. So it's really the top 3. And this is what we were talking about back in the videos, that we're going to have the top players, and it's going to be probably a Pareto distribution as far as where people are watching, where all the eyeballs are at. So YouTube seems like it's going to be the winner. Netflix is going to be number 2, and it's really good to be invested in number 2, followed by either Disney or Prime Video. And so it really does depend on how you classify or how you're going to calculate the number 2, if you're going to add Hulu and Disney together, or if you want to keep them separate. In that case, on its own, Prime Video is doing really well. And this could change. Prime Video could actually start to rank up a little bit higher and overtake Disney, and then it would be Disney in number 4. Who knows, really? So I just wanted to illustrate that, and that gives you an idea as to what Max is thinking, or what the management team at Warner Bros. Discovery is thinking. They're looking at this and saying, well, we need to do something about this because we're really falling behind. We haven't really experienced the growth that we were promising our shareholders, and neither is Paramount Plus. I view it as some of these businesses probably would have been better off just sticking to producing content and then selling the rights to stream the content and taking the profits that way. I think of the companies like AMCX, which honestly has not been doing too hot. And their business has been trying to strategize around their own streaming platform, which I think it's kind of a waste of time. And then also licensing the content out. If I was AMCX, I'd focus on just licensing the content out and generating profits that way. There's nothing wrong with focusing on content production and then selling those rights to stream to something like a Netflix or Hulu or whoever. But coming back to Warner Brothers Discovery, there are some other glaring issues with Warner Brothers Discovery that we've addressed in the past. So just going to repeat myself here. And if you go to the balance sheet, you'll see that as far as debt goes, you can scroll your eyes down to long-term debt, and you'll see they have quite a bit of it. So not to beat the dead horse too much, but if you take a look at the non-current portion of debt, it's sitting at 43 billion, down from the 48 billion, cash of around 2.383 billion. Let me actually take us over to the earnings presentation, and then I'll show you the slide that's actually really important that illustrates the maturity levels or the maturity dates, because it's important for us to at least take note of that. And I'll take the one from November, and then we'll go from there. So give me just 1 second while I get that opened, and we shall proceed. So I'll go here and should be there. So average maturity around 15 years. This is important that they have an average maturity around 15 years, because where interest rates are at currently, if they were maturing, let's say next year, that would pose extreme risk for the company. Keep in mind that Warner Bros. Discovery was given a lot of the debt through the AT&T merger. All right, AT&T, when they offloaded Warner Brothers to Discovery, they also stacked on a little bit of debt, which was unfortunate for the business, and I think that set them up for some hardship in the years to come. 19% of the debt is due within the 3-year period, and that's what brings a little bit of worry to at least myself. The company has been focusing on paying down this debt, but at the same time, it's an uphill battle that Netflix and their competitors really don't have. Disney also has a much better debt structure for their size. And a lot of the debt that Disney was able to issue was issued at extraordinary length of years and at really good interest rates. So Disney actually issued some bonds recently in the past couple of years for roughly, I think, a 50-year period, which is actually crazy. It was them and Brookfield that really took advantage of the low rate environment. And at the time, people, well, even at then, people actually thought it was a good idea. No one really questioned it as a terrible idea. Okay, I have Apple, sadly. What do you mean you have Apple? That's a sad thing. So let's see. Not that it should influence anyone, but Seth Klarman has a sizable position in Warner Bros. Discovery, 25 million shares. I think Berkshire owns Para too. Yeah, no. I don't let that affect me at all. In fact, I will criticize these companies regardless. So I've criticized Para, and I've had my issues or gripes with Warner Brothers Discovery. I think that there were more obvious investments back in the day, and even today, they're not. These are difficult, let's call it, obstacles that these businesses must overcome. So the debt is not something that should be taken lightly, and it is going to be an uphill battle for years to come. So in my opinion, that's why, again, I sold it. It's going to take too long for us to see the light at the end of the tunnel, and I'd rather invest my capital elsewhere. Even though it was a small position, you could have argued you could have kept it as like a watcher. I stated in those updates back then in 2022 that I already have my streamer, and I don't really see the need to own another streamer realistically. Now Disney's actually made it in there, but that's a little bit of a different play. It's not a pure play streamer. It's not a pure play on content. It's more of a holistic view on a business that, if they so wanted to, could make a lot of money and be successful, but they just choose to get it in their own way. The value for me comes from how much I watch, or I hate watching ads. Oh, that's true. Okay. Let's see here. Warren, coming back from Japan, asked about Para and said, "What? Wait and see." I think this is what he was talking about. Oh, he said wait and see? If he actually said that, I didn't pay attention if he said that or not. I love YouTube Premium. Yeah, no, YouTube Premiums of the subscriber numbers are going up a lot. Calvin Mindset, do you think Google will continue to crack down on ad blocks? Yes. I switched browsers and they stopped bothering me. No, I think that's definitely one of the next legs for growth that Google can really tackle. Focusing on optimization of the platform. All of the viewers that use their platforms without watching the ads are technically of no loss to them if they don't watch. And that's true of the entire internet. So if you're an ad-based business and you have people that won't view your stuff because it has ads on it, then it's of no loss to you. Their viewership gained no additional economic benefit. So as a business, I think that Google, in pushing this traction, there's really no one else that can compete with them at this point. You're not going to go to Rumble. You're probably just going to not watch the YouTube content if, for example, they stop you and you're so hateful of ads that you won't watch a 30-second ad or 15-second ad or won't press the skip button or whatever, that in that instance, Google sees no economic loss in losing you as a viewer. So you got to view it from that perspective. Of course, the content creators might think differently. For example, in the case of content creation, you might create content and then that creates a community of people that they don't really like the ads, but they'll support you directly. They'll go on some creators' Patreon, etc., and then they'll support the creator because they appreciate them. And that viewer is now gone because they don't want to watch the ads. That is where some creators kind of come in and say, well, no, I don't like that they're doing that because it's actually going to harm them economically, but it won't harm Google. For Alphabet, they won't really feel that. In fact, it's more of a cost if you think about it, because if they're not generating any revenue from your viewership, then it's just costing them to bring the content to you. And if you think about that at scale, it's still money that they can save. They can improve margins. And most of the people that are really adverse and have some form of ad block, they themselves are, let's call it, the majority of them are not going to go, let's say, stopping watching the content. They're going to continue to watch the content just with ads. So I think it's a natural progression, and I'm in agreement with it. At least from my investment in Google, I think that's a good business move. Do you think Netflix will move to crack down on password sharing was a good idea? Yes. No, it was a fantastic idea. Oh, no, it was a wonderful idea. I see a lot of negative perception from the public because of it. Well, the issue with that is all the negative perception, all the people that say, well, I'm not going to watch Netflix anymore. Again, that's a cost to Netflix. If you're not giving Netflix economic value, then you're just an economic negative to that. So you're reducing the economic value of Netflix's business because it costs them money to put the content in front of you. And if you're not paying them, then they lose nothing by losing you. But if you're a subscriber, yes, then they're willing to do a business transaction with you. You pay them money and they'll provide you the content. Now they can actually generate a profit. So most of the people that aren't going to watch it anymore because now they can't password share, it's of no loss to Netflix. If they never watch Netflix again in their life, Netflix loses nothing. However, if a lot of those people, which again, that would be me, if you can't actually share your password, you're more likely, in the case mine, to fork over, oh, whatever, $10 for the content that entertains me. And then when people are over, we can watch a movie, etc., all that. So Netflix is worth it, at least for me. And it's not really that much of an economic detraction. Password sharing, I mean, I don't want to sound like, oh, it's a trivial amount of money. No, but I get it. But at the same time, from Netflix as an investment perspective, from the business perspective, it's of no economic loss that those people aren't watching Netflix content anymore. In fact, Netflix will just save money on the costs, if anything. Okay, so YouTube can eventually have its own Stranger Things, but Netflix will have to big rogue mindset live stream. Netflix is going to be advertising them. Netflix going into advertising makes them interesting. Okay, yes, it does make them interesting because, again, offering more optionality for how someone can become a customer and provide you economic value is always a good business decision. So if you keep increasing the prices on the premium end for content, for the higher definition, etc., then you can also offer an additional, let's call it tier, which you already know, the ad tier, for customers that aren't willing to pay as much, because for them, maybe that amount of money a month is a significant amount of money. So Don't you think Warner Brothers and Paramount has a variety of content and libraries that Netflix currently has to build? Yeah, but it's not saving them. People aren't watching it. Clearly, that's the thing. So this is the argument I heard last year when Netflix was trading at 180, and it was always the argument I had to be on, like, the defense with Netflix. It's like Netflix, it doesn't actually matter as much as you think that you have a library of content. Let's call it, the vast majority of viewership doesn't actually go back and watch the older stuff. The vast majority of viewership is concentrated in the newer content. So the older content is cool to have, but it's not as important as having new stuff constantly. And so Warner Bros. Discovery, and that's why they're investing so much, by the way, because if we could use that argument and say, oh, having a library of content is a massive advantage, then we should see that as a savings in the growth capex, or the growth investment in the budgets for new content. But we don't. They're actually increasing the budget constantly. And there's a limit, right, to the growth, and that was the thesis. That was part of the thesis of Netflix, because people thought that the growth would be infinite and they would never have any profitability, when that wasn't actually the case. There is a threshold where you surpass, and then every incremental investment after that doesn't yield the same amount of results, and you kind of put a pause on that growth. But having that content library isn't as impactful as people might think, because the older stuff, again, the vast majority of viewership is actually more focused on the new content. People want new stuff, they don't want old stuff. So that's something that you should think about there. Okay, Warner Bros. Discovery might be a national museum, control some Paramount cheaply. I like Warner Bros. Discovery and Paramount merging, because then people who want to make a bad investment into an over-leveraged company can now get a 2-for-1 special. Damn, that's a rip. They both have debt problems. It still will be a big problem after the merger, unless there's some big clause at the merger, in that merger, I don't know of. No. That's the point I'm actually illustrating. That's the crux of the argument, that you still, at the end of the day, have debt-laden companies that, if we again go back to this graph here, you still, at the end of the day, are still behind everyone else, pretty much everyone that matters. Okay, so you're still behind Disney, you're still behind Prime Video, still behind Netflix, you're still behind YouTube. There's so much you have to do to catch up. They're doing this not out of a position of strength. This is out of a position of desperation. You have two weak players, and I think the story's played out here. So me saying that Max is a weak player is not some profound idea. It's very obvious. And if you're arguing the opposite, that their content library is going to save them, I don't know what to tell you. I don't know what to tell you at this point. Right now, we're not in the period of last year where I thought when people were making that argument against my Netflix position, against my thesis to buy Netflix, I thought of it as a fair argument, a fair point, because we don't know how this is going to end up, right? We still wanted to give HBO Max, the new Warner Bros. Discovery, a chance to prove themselves. We were projecting, or a lot, not we, but a lot of people were projecting that they were going to take a lot of share from Netflix. Well, the story is played out now. And so continuing to make that argument at this point, I think, is a bit problematic. Now, if you start to say that the Paramount Plus and HBO Max, or sorry, HBO Max, I keep saying that, but the Warner Bros. Discovery and Paramount merger is going to change things, I want to push back there too, because there's no evidence to suggest that that is going to change, because the content's still going to be the same content. You still have the same management teams that are going to work on the marketing and the promotion of the product. And honestly, if I had to be honest, the HBO Max, which you keep hearing me say the word HBO, is because they got rid of the name. I think that was a huge marketing mistake, because HBO was an iconic brand, and now it's just Max. Consumers can get confused, believe it or not, and they have to almost rebrand it or come up with a new strategy to get in the minds of consumers. What does the word Max even mean? Netflix basically came in and redefined the streaming space. So they're the absolute leader in terms of streaming as far as branding goes. And then YouTube, I think, also made themselves a staple name. Hulu, I think, is significantly weaker. Prime Video, being just part of Prime by virtue of being part of Amazon, has a huge advantage in terms of expansion. But anyways, we're ranting on that point. I thought private equity would be eyeing these guys. I remember Pear sold off to Simon. If Paramount or any of these guys was sold to private equity, that's a mistake for private equity. I'll just say that. Okay, so at least I paused. Oh gosh, I'm not reading the last. Santa Rally is dead. We'll talk about the Santa Rally in a second. Does this mean they can grow the dividend? Yes, they can. Where Fubo? Oh god, Fubo is a business. If you actually subscribe to Fubo, you notice how expensive the product is, and I have no idea how they don't make money. Obviously, if we looked, we would find out, but I have no interest in researching Fubo. Okay, so I thought, oh wait, we already read this one. So they merged Discovery Plus and HBO Max to make Max. Now they merge Max with Paramount to make. They're gonna reduce. They're gonna reduce. It's gonna become X. That's all. Kathy Wood is up 100% equals minus 50% drop probability up to 90%. Oh, we're increasing the. It's not a Santa rally. It's a Kathy Wood rally. And let's actually take a look at the share price of RK. Okay, so I'm gonna go ahead and share this with you guys. So RK is actually down 4% in the past month. RK is up 16%. And let's see, what is it year to date? Up 67%. So, okay, so we're actually slightly above RK year to date, because year to date, bro, matters. Okay, so let's see. Would you say that Netflix has more in common with Costco? No. Then it. Oh, no. That's too different. At least in how they remain in the first place due to market leader delayed reactions. Oh, I see what you mean. Okay. Not in terms of products or anything. In terms of just being the market leader. Yeah, I could make that case. There is a scale benefit. So the bigger Netflix gets, the better they get, and that's not necessarily the case with some of the other guys. That they have to catch up, and catching up for them means spending a lot of money they don't have. So Netflix has gotten to that scale where they are the elephant in the room. The other guys are the smaller players. They are the bigger player. If we were having this conversation 15 years ago, it would be a completely different discussion. But we're having this conversation in 2022, 2023. Netflix is the elephant in the room. So they have all the firepower necessary to produce tons of content. And if I'm being frank, it's a mixed bag at Netflix. But the point is that Netflix throws money at everything. Not literally everything, but they throw money at a lot of things. And so I say this a lot, but people forget that film, TV shows, as a medium, it's a creative medium, which means you got to try a lot of things. You got to break a lot of things. A lot of things aren't going to work, but then the things that do work, you want to promote that further. Disney is something that has a let's apply this methodology, this formula to everything. And if it doesn't work, it's a high risk because you could argue that Disney's creativity has died a long time ago. The ability for Disney to create profound content in the past couple of years is frankly dead. And as an investor, I'm saying this. I think they have the potential to get out of this if they change the culture at Disney. But that's asking for maybe a bit too much. And then HBO Max, arguably a lot of the same things are happening there. They have just a couple shows that really just make everything. But outside of those shows, there's not really much new stuff. So if you think about it, they had The Last of Us, they had The House of the Dragon, they had Succession, which is now over, and prior to that, if you see what they did with Game of Thrones, I mean, after season 7, absolutely abysmal. But they don't really have a ton of shows that are binge worthy. They have some shows, but when they do hit, it seems like they hit really hard. But that doesn't seem to matter in the data, and you have to pay attention to the data, not how you feel. And so the data is saying that Netflix is dominating. And Netflix is also dominating, kicking their butt apparently in reality TV. And it is what it is. Whoever Netflix hired to guide them in that direction is definitely doing a better job than whoever Warner Bros. Discovery has. Because Discovery, you would think they'd have it in the bag to produce tons of reality TV content and actually really benefit from what is considered to be cheaply produced TV content or cheaply produced entertainment. And has a really good ROI, because that's all reality TV is. It's really cheap to make, and it has a pretty good ROI versus something that's narrative-based, narrative-driven. Those are more expensive and questionable ROI. Netflix has also been embracing the international markets and making international TV shows really famous everywhere else in the world. You think Squid Games wasn't originally intended to be something for the Western audience. It was meant to actually to be a local market product, and then eventually just blew up. And you also have movies that like Triple R, where it's an Indian movie. It's actually a pretty good movie on its own. But if you actually listen to the producers of the movie, they actually, I forget what interview I read it in, but I found it interesting. They said the words, "We need to be on Netflix," and I was like, wow, why would you say that? We need to be on Netflix because they have the network that we can expand and get our movie across to all these different audiences. Something that's a lot more difficult to do in something like a Disney because they're a bit more rigid, and so they've lacked the ingredients necessary to be a successful platform for what is known to be a creative medium, right? So just remember that. What is film? What is TV shows? It's creative medium. So you're supposed to have creative destruction. You're supposed to try a bunch of things. You're supposed to produce all this different kinds of content and then just water what ends up working and then just cancel whatever doesn't. So then you end up with what some people say, there's a ton of bad shows on Netflix. Like, yeah, you're supposed to try a bunch of things. If you try to be scared, if you start being scared of producing new stuff, you end up with, frankly, more high risk, let's call it, because if you just apply a certain formula to all your shows, a la Disney, then I think you end up with just the potential for a whole generation of stale content. So anyways, enough ranting about that, but I hope I made that point across enough. Warner Bros. Has been able to tap into gold mines like Game of Thrones. Well, that's the thing. They're not even able to capitalize on it. And you would think Warner Bros. Discovery had it in the bag with the previous Lord of the Rings content that they could also work with the Tolkien estate to produce further IP in that universe. But no, they gave it up to Amazon. Oh, and look what Amazon did. Amazon butchered it. Gosh. And by the way, Netflix doesn't have blunders. Netflix blundered the Witcher series. And what's coming out later is going to be terrible. And this last season, pretty bad, if you ask me. And I think that's not. You're getting Jay Nagy riled up about Disney. Me, Kevin is shorting Costco. Well, good luck to him. It'd probably work out. I don't know. Should Disney just focus on their theme parks, cruise lines, while using movies and shows as marketing? Well, that's what they used to do. I think they have a shot at getting to number 3 in streaming. They have a shot. They can do it. But they got to focus. They got to sit down and focus. They got to want to win. And if they want to win, they can do it. Thoughts on Iger mentioning Disney exiting the spotlight in the political? Absolutely good. This is part of the 3 pronged criteria that I wanted Disney to do, right? I provided 3 points that Disney needed to accomplish, which would make me a lot more excited in the business. One of them was exiting the political arena, spotlight political arena, but just recently started another fight with Elon. Okay, yeah. So on that second point, I think Disney should stay out of the fight completely. So starting the fight with Elon is a bit of a ding for me. So they should just stop. So Nelson Peltz nominating 2 new board members to Disney this week. Impact? Yes, impact. Because if you read Nelson Peltz's proposals, they're pretty much it's almost a copy paste of what I wanted Disney to do. So if Nelson Peltz in this case says to vote in his direction, I'm voting all in his direction. It doesn't matter that I can't make a difference because, I'm not like a multi-billionaire, but I'll still, throw my hat in the ring. In this instance, every vote counts because money's on the line. And Nelson Peltz's ideas, I think, will provide a lot of value to Disney. I think there's a lot of people that need to be fired from Disney, if you ask me. Okay, so Elon literally started the fight with Iger. I don't care who started the fight. Iger just needs to be the bigger man and stop. No point in producing any form of controversy. Disney needs to stay out of any controversy. They need to be completely agnostic out of anything. I don't want Disney involved in anything. Okay, so it's like the customer's always right. Disney needs to be like that again. The customer's always right. Okay, time to stop trolling. Elon banned Disney in Tesla cars being played. What? Oh, I didn't know. I don't know if this is true. Okay, so next topic. The Santa rally, is it dead? This is a little bit facetious because no, I don't know if it is, and I'm not going to make an actual legit commentary on it because who cares? A point is that we try to find different businesses at any point in time, and I think there's still plenty of opportunities to accumulate certain sectors. So what is the impact of activist Carl Icahn, Nelson Peltz? Who's the most impactful activist? Well, good question. In recent memory, I think Nelson Peltz has provided incredible impact. So, for example, if you remember Procter & Gamble, Nelson Peltz actually got involved near basically the bottom in the last 10 years. And so let me actually zoom out here to preach some history. So around this period is actually Nelson Peltz's involvement. And you see how it's changed. And he even went on CNBC. He called it a company that's out of touch with the millennial consumer. That's what he said about Procter & Gamble. And he was right. He was right. But yeah, I was here for the dead Santa. Well, let me kind of discuss maybe like a cautionary note. So there are some credible points as far as what could cause the Santa rally to continue. So if rates go down in the next year, yeah, so of course, from a comparability standpoint, the attractiveness of equities will start to increase, because if you're looking at money markets are yielding roughly 5% or so. So Merrill, I'm getting 5.02%, something like that. And so with my money sitting there, it's just generating, stable cash, relatively speaking. But if I think, for example, maybe the interest rate I'm getting there is going to come down, well, now maybe I'm going to be more enticed to start deploying that into equities. Maybe even if I'm more of a fixed income kind of guy, I'm going to start to go up the risk curve. And then maybe the preferreds are going to get bid. And then after that, maybe, certain dividend stocks are going to get bid. And then you can also see, for example, and that's just from a capital flow standpoint, you can also see, for example, some of the higher debt laden companies start to appreciate a bit of a rally there, because the cost of capital is going to start to come down. The risk of refinancing is going to come down. And, for example, we've been talking 2023 as the year of accumulation for REITs. I've done plenty of private content for the club members, and as well as I've also posted publicly here on YouTube that 2023 is the year of REITs. You can check out my posts. I actually highlight one of the videos. If you go down through one of my posts, I think it's like the 4th or 5th post down, just scroll down, not the videos, but the posts, because it actually is reposting one of the videos on REITs alone. It's about an hour, some odd long discussion, just simply on REITs. And that discussion occurred in Q1 or Q2 of this year. But anyways, when you look at what's going to happen potentially with these real estate companies, the cost of capital is going to likely come down, and that's going to lead to a re-rate in the stocks. So they're probably going to lead higher. Some people are saying that this is really good for tech. Maybe not. That's really nuanced. You can't really make a broad discussion. I mean, of course, I would benefit from that, but I don't necessarily agree that just simply because rates come down, that's always just going to be good for tech. I think that's, again, a more nuanced discussion to be had. Now, some of the, let's call it, stocks that were previously at risk of bankruptcy, some of the stocks that, let's say, delve a little bit deeper on the risk curve of lending, they might benefit from rates coming down for sure. And they might get a little bit of a boost here in the medium to short term. But I question some of these business models, these shitcos, for lack of a better term, how they're going to do. When am I trimming Meta? Well, I have no plans on trimming Meta, at the very least, until all of it is 100% cap, long-term cap gains. But I really try to look for if there's like an alternative for another investment. I don't just like to sell a position just because. So if you look at, and this is talking directly at club members, because they see the portfolio, and as far as like the changes go, sometimes they think I get in and out of stocks too much. But if you look, it's basically only the bottom ones, the lowest allocation ones, that might be trading in and out of. And it seems like I'm trading, but in reality, it's because the lower concentrated bets, the low conviction bets, they're always going to be the ones that are going to be cut first, because you're always trying to allocate to your best ideas, and you don't want to distract yourself too much. There's sometimes when you start, small accumulation, and it ends up building to a larger accumulation. There's been a couple. No, Dollar General was a admitted mistake. And in fact, actually, I got a request from someone in the club today saying, hey, you should probably make a video maybe exclusively discussing, your losses, this year, because they were saying you're having too good of a time. It probably will humanize you a little bit. And what I say, no, my losses are all shown in the past trades category. You can filter out for all the gains, and then you can see all like the losses ones. And the biggest one this year was Dollar General. But if you consider like the actual size, the proportion, I've managed the risk quite well in the portfolio. So a Dollar General at the maximum in the personal holdings was around 2.6. There was a period where in the holding co, Dollar General got a little bit larger, I think closer to like the 6%. And then once we sold, we actually added back. And then so the net amount, according to the broker, according to Merrill, we actually made, I think, like 1% total, because we also, when we sold, we were actually able to buy at a much lower price, and then we benefited from the run back up. So it netted out to about a 1% gain. But in the personal, I lost about 20%. And let me just tell you, in the personal, that was a significantly larger monetary loss than the a 1% gain in the holding co, just because of simply capital sizing. But in terms of the holistic view of the portfolio, Dollar General is only about I think at maximum was like a 2 point something percent position in the personal holdings. So wasn't really that big of a deal. Okay, so let me see. Dollar General absolutely destroyed me. Yeah. No, I think I've had a very bad luck, we could say, or very bad theses around retail. Retail's always been a weak spot, at least this year. Align, we did good. Alco, we broke even though. Let's see. Dollar Jenny. What happened to TSN? Interested to go back in. Did the thesis change or not the right time? No, Dollar General. I'm sorry, not Dollar General. Tyson Foods. It's gonna have a bit of recovery at some point in the future. But for example, beef takes about 2 years to fix in terms of inventory issues. Chicken, roughly 3 months. Pork, about 6 months. So Tyson Foods probably going to have a recovery, at least in terms of supply chain, in 2024. And that was always part of the thesis. That's why the allocation is so small. But Tyson Foods, I think in terms of being cut, is perfectly reasonable to cut it, because it's not, there's, I think, much better risk reward ideas out there than Tyson Foods. So Fabio going nuts with streams lately. Well, I'm trying to get more content out there, because I finally got a let's say a handle on the scheduling, and so it's good to do these, have fun and stuff. Short on grift bucks, boy. No, I actually got my bonus today, so I put the bonus into the savings account, and going to be buying a property here soon. So yeah, and generating that nice little 5.02% yield. My bonus was low as fuck. Bahaha. So that's the cool thing about my current gig. My current gig has a performance-based bonus on how the overall business does. So for year end, and in this case they didn't decide to let's call it wait until the following year. They actually gave me the bonus this year. So try to, I guess, prop up loyalty. So mine was performance-based too. I'm trash. No, I'm sure you're not trash, strongman. But usually, I mean, sometimes bonuses just ain't that up to snuff. But in this case, like, the bonus is a percentage of the business's profits. It's a small percentage, but still it's meaningful. So it has really room to expand depending on if we can grow the business a lot more. Y'all work? What do you mean y'all work? Of course we work. You think this is where we make our money? Do you see how many subscribers I have? Do you think I do this for a living? Oh, can you imagine that? Yeah. Deal flow still low. Bonuses are meh this year. Well, I hear you. Well, I don't hear it because I'm not in your industry, but I feel for you. Yeah. Bonuses around this time get really good. Fabio got the tendies. Well, yeah. I did do okay. I did do okay. Don't make money off investments, bro. You should you should know this. Yeah, that's the thing. So at least as far as YouTube finance goes, the vast majority do not make money from their investments. All of them make money from grift courses, from YouTube views, etc. That's how they make all their money. And actually, I wanted to showcase this because I'm going to pat myself on the back, claim a scalp here, and we're going to look at this post here because you guys, let me see, let me view it on YouTube. Okay, so give me a second. All right, so I posted this because it's kind of cool that one of the club members actually felt the need or wanted to shout this out. But yeah, because we always do weekly calls, and in several parts of the weekly calls, when I usually cover macro, I covered bricks a while ago and how it's a big nothing burger. But the reason why I felt the need to do this is just like a reminder. If you see, I say at the end, remember them. I say this because everyone's so forgetful. They have such a short memory. And all the grifters who focus on negative content to try to draw in your attention. And I think I make this point here, not all information. So there's a lot of information, not all informative. I hope you know what I mean by that. It's because a lot of information out there is frankly useless, or in fact, of negative value. What it means is you would have been better off not knowing it in the first place. So someone who watches a certain piece of content and then someone who didn't watch that piece of content, that person who didn't watch it is in a better position than the one who watched it. So you got to be actually really careful, and you guys should be selective with where you get your information from. So I'm going to actually call out some channels off the top of my head, and I'm going to be forgetting some of them. So let me start with one of the most prolific ones on this platform. And that is going to be this individual who gets a lot of views. Okay, so here, Stephen Van Meter. This individual is probably one of the most prolific peddlers of fear that I've ever seen. And it's actually really funny because he gets really consistent views. I talked about him last night on my live stream as well. And you can see that he uses the exact same thumbnail for absolutely everything. And Strongman's actually gone after him for also pumping penny stocks. So in addition to being useless information and probably a net negative value to you, and that's probably who you could make the argument that this is attacking. Well, let me actually clarify. And I think he is actually he's against bricks. So I'm not going to say it's him, but he is more so of the overarching theme of negativity. So bricks in particular, he wasn't for bricks, and same with some other peddlers. But I'm going to shout out some people that I have. So you also have, off the top of my head, Peter Schiff, right? You have the Jay Bravo guy. You have a couple guys who all peddle fear, and they're probably a little bit more on the bricks is actually a big deal, or the dollar collapse, et cetera, et cetera, et cetera. So look, Jay Bravo, 208,000 subscribers. We go to the videos and we see shocking, get out, happens now, brace now, this is huge, hell is coming, revealed, get out, brace, get out, breaking news. How many get outs does he have? Dear God. The end, shocked, whatever. So point is, fear peddlers, and that's who this comment's really trying to address. So this post was trying to address those. And what I say here is, please remember them. Okay, please remember them. And I also tweeted it as well. Please remember them. And so next time they post something, you go, oh, you were also the guy who said that this was going to happen, this was going to happen, and none of that happened. So stop posting polls, man. Hey, Big Pharma Show. Today you're on that account. Stephen Van Meer is the king of that. Yes. Game of Trades. Yes. You. I don't know if it was you or someone else who shouted them out tomorrow. Thoughts on about LHX at these levels? I'm kind of neutral on L3 Harris. I think they're okay. They're decent. They're going to stop their M&A activity. Last time I checked, and so they're just going to focus on organic growth, which I think is a positive. I prefer companies of higher quality like NOC. Not that LHX is bad quality, but there's higher quality companies like NOC. So on any weakness, if they're trading at relatively similar levels, not financial advice, but NOC, what I would do for myself, because I already have NOC too, is probably add to Northrop Grumman. I mean, honestly, Bobby T, because those are the only two. Oh, that's kind of funny though. Those are the only two keys you could find. Can you explain the move in ARGX? I don't know, Big Pharma Show. You know more than me. My flawless strategy, buy VTI, short VT, flawless. Okay, yes, they're actually going to merge, but we already talked about that. It's basically at a point of weakness, so that's more in the beginning of the video. Okay, finishing up the discussion around the death of the Santa rally. I think it's pointless for you to focus on that. I think that you're going to be better suited just still trying to stick to a strategy. If you're buying the index, you should just continue to buy the index and ignore any of the noise. It's all just noise. Continue to dollar cost average the index, and you should be fine. If you go down, it's better for you. If it goes up, whatever. Now, if you're looking for individual companies, I think there's plenty of opportunities still out there. Of course, you have the, let's call it, well, no, let's not call it, the Magnificent Seven. Meta is approaching the $400 mark, at which point I shall retire. And you also have Google. All right. Google is also hitting new all-time highs, or right close to new all-time highs. And I think in terms of the reorganization plan, I think that's a positive move for Google. But I am still upset with Google management. So I maintain that I am upset with Google management. I think that they have a lot of potential, and if they so choose, they can be really powerful. But it's more of a testament to how good the company is that they have such bad management and they still do so well. So maybe it's like that saying that Warren Buffett says, you want to buy a company that despite having bad management, despite having a moron running it, it still works well. Well, that's Google. Google's one of those for the time being. So buy VT, VTI, and VXUS. Yes, that is the way, the overlap. But yeah. Let's say Play Store will be a big hit. Play Store will be a big hit. Amazon's still a buy for you here. No, I've actually paused Amazon purchases. I have capital that I could deploy more into Amazon, and I've already announced it, or not announced, but addressed it or talked about it in the prior portfolio update, that I've essentially, in my personal holdings at least, paused allocations. I'm pretty much putting all of the new capital into the holding co, which is the one that I update for the club members. And so I've been really focusing on adding capital there. With the personal holdings, it's basically just moving around existing capital. And I still have cash on hand ready to buy Amazon, but it's actually a bit more muted now. Let's see. Since you hate the Santa rally, your stocks will not go to the moon. Well, McBuda. Google Play Store lawsuit. Well, if they lose, I think it's okay, a temporary loss, but it doesn't really change the overall strategy behind Google, or the overall business behind Google. I don't think it's like a massive destroyer of the business. Then short it. Whoa. There's a big difference between not buying anymore, taking a pause here, and shorting something. Google, they rely heavily on search revenue. So that's actually what I've been saying about them versus Amazon. I think Amazon has way more levers. If you see the content I've made on Amazon, I think Amazon has a lot of potential, more than Alphabet. And that's why I've actually made Amazon a larger allocation than the likes of Alphabet. I think I'm going to do much better with Amazon over the coming decade. And I think that they're the best position in the cloud, the best position in AI, the best position in robotics that no one talks about, but they're the best position in all of those categories. I think are actually going to be huge. Unlike the hype companies that are saying, look at us, we're so good at robotics, Amazon actually has a very competent robotics department, a very competent AI department, and a very competent cloud department. Microsoft is a very competent AI and cloud department as well, right? But they have, I think, the more famous AI department. Alphabet has fumbled the ball, but I think they still have a chance to recover. The ads business is that good that the business still can make even more money for the coming years. And then Meta is also, well, surprisingly, Meta, if you go back to my Meta thesis, remember I said that the Meta Quest, it's not needed to actually do well in Meta. It appears actually the numbers are coming out that's actually doing quite well. It's becoming more and more popular. Some of the club members actually brought that to my attention. So I was like, okay. Well, my initial thesis didn't even require that to do good. So if that starts to actually pick up, hey, Meta could have even more room to run, because that's a whole other business element that I said I value that at 0. It's just a bet. It's a gamble. It's a cash burn. It's either you should buy it or you short it. Oh, love that. Amazon first party retail is frustratingly low margin. Do you think that they automate the fulfillment? Okay, so if you go back to my Amazon thesis, my video on Amazon, which it should be public. I think there's a public video. But I had a write-up on Amazon in October of 2022 within the club, and it addressed some of that. So basically, because now it's old information, I'm perfectly fine talking about it. The retail portion of Amazon is not necessarily necessary to make money. At the most, it just break even, drive the highest value to customers, and then you can get customers into the other avenues. You can generate profits elsewhere. For example, in advertising, Amazon ads. I'm going to repeat it again and again and again, because this is my claim. Amazon ads will overtake Meta's ads level of 2022 within the next couple years. When I say next couple years, give it 3 to 4 years. In 3 to 4 years, what Meta was in 2022, Amazon ads will overtake that. So I think that it's only going to get more valuable, and that's where the real cash driver is going to come from. Then you have Amazon Cloud, right? AWS. We want to make sure that continues to perform well, but Amazon ads is going to be where the eyeballs are, or at least my eyeballs are. And then you have the retail optimization, which if they can drive margins a little bit higher incrementally, that's a bonus. That's amazing, right? And amazing, pun intended. So if you hear me say amazing, right there. What is this? What's your conspiracy theory on the move late in the day today? Who hit the red button? Jerome Powell. Well, you just day trade it in the next week. Yeah, I will day trade Amazon next week. There are some analysts who claim that a $1 trillion AWS and Amazon ads account for the whole valuation, and the other segments are free. Maybe this is too bullish if the AI takes off. But yes, well, I mean, I will be happy because I have a lot of exposure to Amazon now. But we'll see. I'm not really betting on the AI taking off at any given point. My thesis only accounts for ads and AWS, and also that retail remains break even. So that was my thesis when I did my write up to the club members, and also when I pitched it to the club members via the weekly calls or ICOMs. That was on an ICOM. And it was just essentially that if you just look at those key metrics, that's actually where you would want to focus on the performance, and any of the retail. If you do see some profitability there, that's just bonus. Now, some other things have changed. So some things have changed to the upside, where if I were to really relook at the numbers, I'd kind of be a little bit more generous. So the new business, the new logistics business inside of Amazon, I think has potential because they can offer that now and actually profit from that CapEx that they otherwise before I counted as just simply part of the break-even point of the retail sales. So if they start to actually make profits or generate profits from that, then I have to up those estimates a little bit more in the future. So yeah, that's my quick commentary there. Okay. Thesis Plato. Where can you find your thesis on Amazon? So you can find my write-up within the club. My thesis on Amazon, there should be a public video. If there's not a public video, that means it's only private. And I can make it public at some point. But there should be a public video on the channel going over the Amazon thesis. If not, there's also the live streams, but I know the live streams are really long. And I definitely have covered the Amazon thesis in the past during this year. Definitely. But they are long live streams. Like, for example, I just did it, and it's not even going to be in the title of this live stream. So if you were here live and you watched me, you heard it. But if you were someone who was looking through videos, you would never see it in the title. So in live streams, unfortunately, that's how it is, because I don't have an editor. I don't have a hired editor that will come in and just change things up and change the name or change the title for anything interesting I say. I just keep it as is because we move on. We move on to other things. Okay, crazy that Amazon at its conglomerate $1 trillion market cap size still operates like a startup. Day one mentality is strong part of the culture. Yes, yes. After speaking to plenty of people who still work there and have worked there, yes, it's definitely, they have a lot more churn in terms of employees. In other words, hit the notification bell. Well, yes, if you want to see more content from me, which you see I'm picking up in terms of content. I told you guys that I would, and I am. And I have a video coming out later this week, another one. I'm trying to get maybe 2 to 3, let's call it 2, because I don't want to get too crazy with the work schedule, but 2 videos a week as far as recorded videos, and then live streams can be a little bit more liberal with that. And then because you have to also keep in mind for the club members, I also produce a very 2 private videos a week, well, live streams a week, which is sometime in the beginning of the week and then on Thursday, where we do like the pitches and stuff. But so I have to balance all that. Those are the things that you guys don't see out here. So you might be wondering, what the hell is he doing? And before, when I was kind of still getting my feet in terms of the scheduling, I still had to focus on producing those 2 weekly content pieces. So they were taking up all my time. Okay. How are his 8 businesses? I don't know who's that. Can I borrow 1 million, please? You want to borrow 1 million? All right. It's going to come with pretty high interest rate though. All right. Checks and cash at the end of the day. We're all just checks. He's cashing us through PayPal. Sad reality. Well, yeah. PayPal is used. Okay. So we are also going to talk about Steelcase. So Steelcase is the company I tweeted about that I'm looking for an exit. Nothing's changed. I am looking for an exit. We saw it rocket up today after it actually declined post-market yesterday. And what happened? Well, I am capping on Games Workshop. I got to get Games Workshop. So Steelcase as a business was also, now there's no public thesis like a dedicated video on YouTube. I should do one even though it is late, but there are pitches and let's call it live streams that are public, but again, they might not have the title. They were discussed in portfolio updates, etc., and where I would discuss the thesis around Steelcase. But within the club, there is a pitch for it, and not a written pitch, a video pitch. And I probably should make a public video pitch for it, even though it's late, but just for the sake of kind of like as a case study at this point, because I don't think the opportunity is there anymore. The opportunity is gone. So with Steelcase, what you had here was a massive, let's call it play. Let's redact the word massive. A play on return to office. So, and I actually received a critical view on my Kilroy video. So if you look at my video on Kilroy, which you can see some of the comments were saying I was stupid for thinking that there was going to be return to office. And I think the argument's a little bit more nuanced, that not everyone's going to return to office, but Class A office property will do well. And there's going to be not the wide scale, no office environment that people thought we were going to enter. Steelcase benefits from that. Now, Steelcase in their earnings report actually announced or said that projecting into the future, we have reached the trough of their business, which means, in theory, that people are going to be returning to the office because Steelcase deals in a B2B business. That's their bread and butter. The B2C, which I'm sitting on a Steelcase chair, is not the majority of their business. That's actually a very small fraction. So if you bought Steelcase prior to that rundown, which I'll tell you everything money did, and then they bought Herman Miller Knoll, and look at that, what a value trap. And also, by the way, it also coincided with the absolute apocalypse of office REITs. Not a coincidence, because let me actually overlay KRC, one of our other holdings, and you can see it actually really matters when you bought them, right? Oh, who would have thought? It matters when you buy an asset. So what you pay for it will determine your returns. And you can see here that Steelcase actually was a precursor for the performance of how some of the office properties or office real estate did. Now, I'm not going to sit here and make the claim, the hubris claim. Maybe it's not so hubris now, but that Steelcase is also a precursor still for how office properties will perform in the near term or in the future. But maybe, I don't know. So Steelcase was one of these other investments that I kind of was trying to double down with and say, I'm really confident that this trade's going to work out, that the return to office trade will work out. And so I'll put money into Steelcase. So I made it a small but meaningful position. And now over the roughly 7 months that we've held it, it is now up over 90%. And probably a little bit less after hours, because I see that it is down 3.05%, but during today it was up 90 some odd percent. So I'm still looking for the exit because I believe I'm comfortable with these gains, and it's not really a company that I have a lot of confidence or comfortability holding for a very long period of time. It's an ugly business. Even Kilroy, by the way, if you guys were wondering, I've said this in the past, so shouldn't be new news, but Kilroy is also not a company that I would like to hold for a very long period of time. Kilroy and Steelcase kind of get classified more so in that taking advantage of a apocalyptic panic sell and then making calculated bets, if you want to call it that, or calculated investments, if we want to be more formal. That's not the case. That office isn't dead. And so this was yet just another way to play that. And so I'm now even more confident in my office investments than I was before, just based off of Steelcase commentary. So Steelcase is giving me further confidence that if I were to see any further weakness in some of these office REITs, I may elect to add more capital. But for now, I've just actually been collecting the dividends at these levels for Kilroy. And I think I have a pretty good idea as far as what price points I'll exit. But I'll collect the dividend and I will reinvest selectively. Right now, I'm taking the dividends and just doing something else with it. Yes, you're late to the game, but yes, they are merging. You provide enough information in each video for you to digest. Please don't flood us with useless videos. Your rate of videos and sustenance is just fine. Perfect. Love to hear it. So yes, I probably will bring back some kind of let's call it community requests, because I get a lot of requests. And so you watch the ones that you're interested in, you don't watch the ones you're not interested in. But there's always the videos and live streams where I discuss the points that I'm interested in as far as, like what investments I want to buy. You're late, Cole. Yeah. Shame him. Everyone shame. No, I'm kidding. Because of South Park, maybe, I don't know. Agree Realty, Marcel, you should know it's an investment of mine. I like it, but I don't really see an immaculate amount of upside to it. So you're not gonna the likelihood that there are scenarios where it does really, really well, but I don't think it's such a clear answer that the let's call it the returns from here are going to be market busting returns. It has a good chance to outperform the market. Really does depend on where the cost of capital rises and if they get re-rated. If that happens, then you're probably going to see some outperformance. And Agree Realty is a company that if someone offers me a certain price for it or a certain yield for it, then I will actually be gladly to sell it off to them and then hunt for something else. Because right now it's just 2023 was an exceptional year, in my opinion, to accumulate some of these assets, in particular REITs. These market returns are bussing. Yeah. Okay, so glad you finally joined us, Cole. Agreed. Agree or easy money. Why didn't we pick up O when it was in the 40s, by the way? For me, I don't really have interest in where O is going, so I just don't agree with their current strategy. Easy for me to say. That's my quick explanation why I didn't pick up O. I was picking up other REITs instead, but not O. And actually, I'm really hoping this is a pullback because, it's a bit complicated because, it's a bit complicated because I do have a cash account that I am accumulating for also purchase of real estate. But if prices get too good at some point, I can't say that I wouldn't take from that account and deploy it. But other than that, I would argue I don't want to. Let's call it like a fully conscious and aware Fabio doesn't want to, but things get really red. Well, that person might do something that the me right now who's talking to you won't like. Maybe this will be a good excuse to sell my Warner Bros. Discovery. I'm almost done with the DCAU movieverse. Well, they were given a tough hand. That's the problem. AT&T. This is all AT&T's fault. So call up AT&T and tell them it's all my fault, or it's all your fault. No, never mind. It is all my fault. That Warner Bros. Discovery is underperforming. Fabio capping on buying real estate for cash, for real, on God. Lucas is picking up all the slang now. Well, I bought the stock, so okay. But that pretty much covers the gist. So Steelcase, in summary, I'm looking for the exit door. It's done really well, really happy with it. Really brings up the confidence that we are going to see return to office, but primarily in the A class. I think I can put that line in the sand. That's going to happen. And even Kilroy at this point, from where our average cost is, it's actually done a market beating return. And if you add dividends, it's even better. So Steelcase, my real case, yeah, or real face. But Steelcase, very ugly business. I think for the most part, it still could have more room to run, by the way, because it's still optically cheap. But I'm kind of more or less happy. If it wasn't for the tax implications, I'd probably already be out. But I'm looking for what's the best or most optimal way to exit the position at this point. So not a long-term hold for me. Definitely not a long-term hold. And then Warner Bros. Discovery, I mean, we're still seeing some interest around this. So just to summarize it from prior in the video, this is still the problem, right? This is still the problem that we were talking about earlier in today's video or live stream. You have Max and Paramount that combined will still be less than the content pool of Disney through Disney Plus and Hulu, and still really far behind Prime Video and really far behind Netflix and YouTube. So it's basically like one of the two weaker competitors are merging. And yeah, I will be making a video on Siltronic, my iconic, because that's a company that I've been accumulating. If you guys have been paying attention to the portfolio updates, and you've been paying attention to the portfolio updates, I do also want to provide. I think now the time between when I presented it to the club and when I do a public video on this thesis, I think is sufficient. So I'm going to be making also content on some of the semiconductors. So I'll be making this. I won't be turning my older videos public, but what I'll do is I'll make new videos on it, because if I'm being honest, I think that the private content for the club members is not very consumable for YouTube. It's not very. I'm not saying that you guys specifically watching. It's just the algorithm will not like that kind of content. It's too anti-goldfish. It has to be made a certain way. You gotta have a bit more visual flair. You gotta have basically not too many pauses, and it's more of a panel speaking on the matter. But I'll be making content here soon, hopefully, on the semiconductor plays that I've also been accumulating. So one of them is including Siltronic. Okay, 'tis the season. So, well, the thing with TMF is you do have to be very right on the timing, and so it's very there's better ways to play yields coming down, and I think now my position is significantly better from a risk reward perspective, where I still generate a lot of returns from yields coming down, but I think in a much better risk adjusted basis. So I don't have to worry too much about the volatility or the lack thereof from yields. I mainly have to worry about the end direction of yields. So even now that there's some publicly traded stocks that I've covered, like Safehold. I don't have a video on Safehold. I should make a video on Safehold. I have a pitch on it in the club, but I should probably make a public video on it, because also that one's also the time difference is enough that I could probably make a public content video and have given the club members that additional, let's say, time frame to separate it from YouTube. But Safehold's one I could probably make a video on, and I think that's also like a better play on yields coming down or rates coming down. You need to use flame thumbnails. Oh, yeah, that's how you make great content. Fed pivot. What better time could you ask? I do have a movie to go to, so I'm going to actually start closing off here soon. Slowly been acquiring Arthur J. Gallagher for the last 6 months and got crushed last week. Yeah, that's a great business, by the way, Arthur J. Gallagher. But I haven't really looked at it too deeply. I have been looking at 2 insurance companies that I'm looking to probably add to my portfolio. I opened a position in one of them today. I put roughly, well, I almost said the dollar amount. Ooh, a little tease there. No, I'm kidding. But yeah, I put a starting amount of capital in it, and we'll be kind of seeing it for a little bit further. Oh, come on, Paul. Gosh darn it. Did he actually say this? Paul thinks Zillow has staying power. I don't like that, man. You know what? He's saying it. I want to see how he values it and if he buys it. So the profile of Mount Everest. Yes, Marcel, but please do your own research. There's really bad ways this can go that can go south. So please consider execution risk. Oops, sell order incoming, short it. Paul says just enough stupid stuff. This might be true. Yeah. Well, who knows? Oh, but he didn't value it. Yeah, because that guy's too dumb that if you're on his side of the trade, you should really start questioning your life. And that's what I do. If I'm on Paul's side of the trade, I start questioning whether or not I made a mistake. And with Dollar General, that was a mistake. So time will tell with Dollar General. I think my mind wants to say that they can turn things around. But I think there's still when it came down to it, there's actually just better risk reward plays out there than a retailer like Dollar General. There's better retailers, way better retailers than Dollar General. So one of them being, just name one off the top of my head, Tractor Supply, which looks appealing at current prices, somewhat appealing. It could be better. But yeah, and Ulta was one. Ulta barely gave us a chance to even have it in, but whatever. So with that being said, guys, thank you guys so much for watching. If you guys enjoyed this video, and actually before we leave, I actually wanted to do one thing. We need to talk about the poll, and then we'll close it off. So the poll, let's see. I think you need more cyber videos. Yes, we need more cyber videos. I saw that comment just now. I sold Ulta today. What's Ulta at? Ulta. Okay, so we had the okay, so it's kind of the same price. Are you invested in content streamers? The majority of you said no, 52%. 47% said yes. So we're pretty split. Let's call it 50-50. And honestly, I can understand why a lot of people don't like the industry. And I can understand why some people think the industry is awesome and amazing. I think that it's selective. Like certain players, great. Most of them, trash. So I'm still hanging on to Netflix, even though it's expensive now. I am as well. I don't think there's necessarily a reason to sell a winner like that, incur taxes when there's not really another, unless you have another opportunity that you think is really compelling and you need the capital. Think of it as your business now. Not financial advice, but just as a philosophical stance on investing, think of it as your business. Do you just sell your business? Probably not. Maybe if you find another opportunity that's really compelling in another business, maybe make the argument there, but give yourself a good reason to sell, not just I think it's overvalued. Okay. All right. So with that poll, thank you guys so much for watching, and I will be seeing you guys on the next one. Bye.
Okay. We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks. Yeah.